This is the Asia Trade. I'm Avril Hong in Tokyo.
And I'm Paul Allen in Sydney. The top stories this hour. Asian stocks set to track losses on Wall Street with signs of fatigue creeping into the AI-fueled rally. The dollar rebounding as traders pair bets on Fed rate cuts next year. Tech in focus with Intel approaching Apple about securing an investment in the ailing chipmaker. Alibaba's ADRs soaring as it boosts AI spending. Plus a Bloomberg exclusive. South Korea's Prime Minister tells us that US investment projects and trade talks can't progress until visa issues are resolved.
Yeah, Paul, let's get to today's agenda. We're watching for some of these potential high-profile meetings, with Trump reportedly set to visit Japan next month. We also have South Korean media saying that the president, Lee Jae-myung, met with the U.S. Treasury Secretary in New York. So some of these meetings that we are keeping close watch on, Paul.
Yeah, apparently Lee explaining to Scott Bessent as well that look, South Korea and Japan are very different in terms of scale, foreign exchange and infrastructure, so he's hoping that gets taken into account. Also, there's this visa issue on the table to be dealt with as well. Of course, we had that situation earlier this month where hundreds of South Korean workers at that Hyundai battery plant in Georgia were kicked out. The incoming Prime Minister, or the Korean Prime Minister, Min-Seok, had some thoughts on that. Let's have a listen.
Realistically, without a solution, it's difficult to invest in the United States and carry out the various joint projects currently planned between South Korea and the U.S. We absolutely must find a solution. Several projects are underway between South Korea and the U.S. Without resolving the visa issue, meaningful progress remains virtually impossible.
Let's take a look at how markets are setting up for today's session. We, of course, saw the dollar rebounding overnight, along with Treasury yields as traders pare back their bets of Fed rate cuts. And that actually left dollar-yen at this 200-day moving average. It's breaching these key levels, as even though we saw the LDP frontrunner, Sane Takaichi, trying to pare back some of these comments that were dovish a year ago, now suggesting that the BOJ policy should be left to the central bank. We're seeing dollar-yen hovering towards that 149 handle. In terms of stocks, yesterday, don't forget, in Japan, we did see the tech names, energy-related counters doing well. Futures are pointing flat at the moment. Flip the board. Take a look at what we are looking at from Wall Street's handover overnight. Traders pretty much called time on the rally. Tech led the drag. In terms of commodities, we actually did see oil prices extending gains amid hawkish rhetoric on Russia from Donald Trump. A bit of a reversal at the moment. But what was also interesting in terms of the tech names, Oracle, it sold $18 billion worth of U.S. investment-grade bonds. That seems to be competing in terms of corporate supply versus Treasury. So we actually saw yields rising against that backdrop. For the moment, the U.S. 10-year at 4.15 thereabouts. But as I say, Paul, tech is also in focus today.
Yeah, very much so. A lot of headlines in the chips and AI space. So let's start with Intel. Shares soaring after Bloomberg reported it's approached Apple about securing an investment. Our Asia Tech correspondent Annabelle Drewlers joins us now from Hong Kong. Belle, can you tell us a little bit more about this? What's in it for Apple? Because it's got its own in-house processes and walked away from Intel some years ago.
Yeah, that's right. It shifted to in-house processes about 5 years ago. So that's sort of the big question. I mean, what exactly would Apple look for in this sort of investment? Nonetheless, and even though what we're hearing from our sources is these discussions are in early stages and nothing's secured as yet, it was enough to really prompt that big market reaction. You can see here Apple closed a little bit lower. Of course, that was sort of, as you said, that broader sell-off or sell-down that we saw in tech stocks generally taking a breather. But Intel, the big beneficiary, and you saw that gain there of a close of up 6.4%. But the story is, in a nutshell, is that yes, what we've heard is that Apple and Intel are discussing. It has been, of course, a period where Intel has managed to secure these very big deals with the likes of Nvidia, for instance, something else that would have seemed unthinkable perhaps just a few years ago, SoftBank as well. So these are the types of deals that we know the Trump administration wants to see, investment into a major chip maker in the US as well. And a very big vote of confidence, of course, in the company, because CEO Lip-Bu Tan is really at the outset here of what's going to be that multi-year restructuring effort to get this company back on track.
Belle, in terms of tech stocks that fell, we also saw that in Oracle. It managed to raise, though, $18 billion, second biggest bond sale this year. What does this tell us about AI and growth?
Yeah, it tells you that Oracle needs to spend basically or to secure more funds to meet its commitments that it's made. I mean, we've seen in Oracle that it's been able to sign lots of new partnerships with customers. We saw in its latest earnings, for instance, it has very big capex plans. In fact, their cash flow flipped to negative this year for the first time since 1992. It's expected to stay that way until 2029. But the story here is that essentially because they've got those commitments, they've made those commitments, they now need to raise the money to make it happen. And so, yeah, we saw them issuing $18 billion in US investment-grade bonds on Wednesday. What we heard from sources is that the debt has been issued in 6 parts, including a very rare 40-year bond that's been priced at 1.37 percentage points above similarly dated treasuries. So the initial price talk had been 1.65 percentage points. So it kind of tells you that they're managing actually to get that confidence of investors and bondholders because they're able to essentially issue a large amount of debt at some pretty reasonable rates as well.
Belle, feels like every day we get news of another huge investment in the AI space. And yesterday it was Alibaba pledging billions more on top of billions already committed to AI spending. The market loved this news. What's the plan?
Yeah, this has been really the biggest story for Alibaba this year. I mean, it's of course, well, biggest in the sense of AI. Yes, they have that big, huge e-commerce competition, quick commerce competition. But in terms of AI, the market has really liked that narrative for the company. And early this year, they made that big commitment to spend $50 billion on their AI efforts over the next several years. Now they've actually said it's not going to be enough because CEO Eddie Wu yesterday, he was speaking at a conference and he said that globally he sees AI investments topping $4 trillion just in the next 5 years worldwide. And he thinks that Alibaba needs to keep up. Exactly how much they're planning to spend in addition to that $50 billion, we don't know. That wasn't specified. But it's enough for the market here because they're really buying on that major investment. And yes, you continue to see those shares gaining. I mean, yesterday we saw it up at a 4-year high or closing around a 4-year high in Hong Kong. That translated or carried across into ADRs. So it's going to be a big story as well for Asian tech stocks today.
All right, Asia Tech correspondent Annabelle Drewl is there in Hong Kong. Well, let's get a preview of the opens in Asia as Wall Street's rally loses steam amid labour market risks and sticky inflation. Garfield Reynolds is here with us now, leads our Markets Live Asia coverage. Garf, what's going on here? Why is the rally stalling? Valuations, a Fed that's in no particular hurry, or is it something else?
Well, yeah, on the one hand, there's a lack of clear news drivers, especially like your broad news drivers. Yes, we've got some of these AI tidbits, but that's not sort of significantly enhancing the demand story for AI. We're waiting for PCE inflation on Friday, or this Friday, and then US jobs next Friday. So that's all got a bit of a cooling effect. There's a reason for investors to avoid big moves until we get these event risks out of the way. It's also, of course, the end of the quarter coming up, beginning of next week. So given how strong the run has been both this month and in previous months for equities, it makes a lot of sense that you would calm things down. I don't know that we can get calling time on the rally. It's more like a pause that, at the moment, there's a fairly strong case that this pause would refresh because the profit outlook still looks good. The Fed's a little bit unclear about what it's going to do, but nobody seriously doubts that the Fed is easing policy and that it stands ready to ease more rapidly if the economy worsens significantly. So unless we get a series of shocks that show that the economy is in serious trouble right now, chances are that investors are going to decide that any major dips are worth buying. Look at what happened in April this year when we had a massive sell-off on fear about the reciprocal tariffs that has since been erased. That's been the latest example of why buying the dip is seen as being the only strategy that's really worth pursuing.
Gav, does it also then make sense that we're seeing the dollar rebounding along with yields?
Well, again, with the dollar, there's been, a lack of follow-through on the concerns surrounding tariffs that had done a lot to drive the US dollar down. It's one of those interesting dynamics that's emerged this year where everybody expected that tariffs would drive the dollar higher because they would hurt other economies more than they would the US. Instead, the perception was the other way around. I would argue that tariffs have definitely hurt the US economy. It's just that so far that hit has not been severe enough to send the dollar further down from where it got to around the middle of this year. In that situation, you've got, it makes sense again that the dollar and yields are getting back into line. I noted the idea that you would need to see a serious breakdown in the labour market situation for the Fed to start cutting rates rapidly. So unless and until we get something like that, yields look supported around here, and so the dollar looks supported around here. And again, if we were to get that severe downturn and we were to get rapid Fed rate cuts, then you would get the dollar dropping. At the moment, the dollar looks like it's in a bit of a better situation than a lot of other major currencies that had perhaps overperformed.
All right, that's Garfield Reynolds there, who leads our Markets Live Asia coverage. Still to come on the Asia trade, as NATO struggles for a coordinated response to Russia's airspace incursions. We're going to discuss the conflict with CSIS. Ascalon Capital tells us why they've shifted to a neutral stance on US Treasuries. Plus, Commonwealth Bank shares their outlook for oil and gold prices. Much more ahead. This is Bloomberg.
NATO allies are struggling to coordinate a response to Russian airspace violations, with partners in the defense alliance openly contradicting one another. Germany is urging a cautious approach, while other allies are calling for a more forceful posture. Let's bring in Bloomberg senior editor Derek Wallbank. So, Derek, talk us through the differences that these NATO allies are having and how that might affect their response to any Russian incursion.
Avril, it really all breaks down into sort of a key question. And the key question is, when you have a Russian overflight into NATO airspace, what do you do about it? Obviously, the goal is that that doesn't happen at all, right? The strategic underpinning of NATO is something called Article 5. And Article 5 basically says that an attack on one is an attack on all. And it is a sort of like an ironclad thing that means that when you sort of say the edge of the NATO alliance is Poland, the Poland-NATO border may as well be, the United States of America, because if something bad happens to Poland, you have just effectively attacked the United States. That's the baseline underlying, and I have to say that to say this, that NATO is very, very cautious, or has been very cautious in the past, about escalations that could at some point lead to an invocation of Article 5. And that's kind of the underlying debate that you have here. There is a call among some for a far more bellicose response. The idea that if you do nothing, then Russia will continue to violate airspace, will continue to sometimes utilize airspace on route parts of Ukraine, in ways that you do not want and that you do not find acceptable. The flip side of that, though, is that if you do have a major response, if you shoot down Russian airplanes, what does that lead to next? And that, I think, scares a lot of people.
Derek, let's move on to some less volatile territory and some news regarding the US cutting tariffs on cars imported from the European Union to 15%. Is this a sign that trade is entering a more stable era between these two?
Well, Paul, the United States and the European Union did get to an accommodation, and we've seen a couple of what I like to call off-ramps that have been warming that relationship a little bit. The European Union has been looking for stability here, has been looking for a little bit of predictability. And obviously, when you're sort of considering a sector like automobiles, be that Mercedes or Volvo or BMW or Ferrari or whoever else you want to bring in there, is a major sector with a lot of exposure. To some degree, that they've tried to limit that by having or announcing plans for United States investment in factories and things. But all of that takes a very long time to come on, right? And so all of this, I think, is that movement towards stability. Paul, you and I have talked for a long time about this, and one of the things that we've talked about before, for anybody who's tuning into this debate now, is that the sort of first 6 months of Trump's administration were very much kind of putting announcements out there. Sometimes there's an injection of significant volatility in that. The next 6 months, though, really is an implementation phase of trying to figure out how all of this works in real life. That's where you get the idea of this taco trade of Trump chickening out or stuff. But really what it winds up being in most of these cases is that Donald Trump isn't doing nothing, but he's coming short of the maximalist things. And at some point we reach an equilibrium state. That's where people are trying to get to right now. And that's one of the things that you're seeing in the U.S.-European relationship.
All right, Bloomberg senior editor Derek Wallbank there. South Korea's Prime Minister says investment projects in the US will remain in limbo until visa issues are resolved. The two countries are working to revise the visa system after hundreds of South Koreans were detained earlier this month in a raid in Georgia. Min-Seok told us exclusively that the incident's also casting a cloud over talks to finalize a trade deal.
This negotiation wasn't initiated by us. We didn't start from a position of advantage, nor did we raise the issues. Isn't that the case for the entire world? Since the whole world is negotiating under the new conditions presented by the United States, rather than insisting on specific conditions, the correct answer would be that certain things are simply difficult to achieve. Therefore, anything that exceeds the limits of what the Republic of Korea can bear in terms of national interests, acceptability, capacity, or public understanding will be quite difficult to undertake.
Are the issues that need to be resolved around the $350 billion investment fund into the U.S.?
That's generally the case, since the framework for the large amount is already set. The fact that the amount is fixed means it started with the expectation that depending on how that amount is structured, it could potentially be mutually beneficial. However, the structure itself, how the funds are raised or how the profits are distributed, these things need to be within the bounds of what's considered normal. And when explaining to our Korean citizens, it needs to be at a level where they can understand and accept it. Above all, it must be within the capacity of our Korean economy to handle.
When it comes to the tariff themselves, we still have to see the U.S. actually lowering car tariffs on South Korea to the agreed 15%. And even if the tariffs were lowered, the tariff advantage that South Korean car makers had over Japan, for example, 2.5% before the Trump trade deal, that's going to disappear. How painful is that for South Korean firms right now?
First, the FTA structure between us and the U.S. is changing, and that will create a burden. Naturally, if tariffs drop from 25 to 15%, that will be better, but it's still harder than before, and especially at this point. There's the difficulty of having to bear the 25% until this negotiation concludes. So, in short, there are difficulties. Hyundai Motor and others are facing particular challenges. However, as far as we understand, Hyundai Motor currently plans to navigate this situation without changing its pricing policy for now. I personally view this as a relatively wise approach. The government is reviewing various policy options to see what can be done to alleviate the burden on the automotive sector caused by the ongoing negotiations.
More problematic also for Korean companies has been the visa issue, especially with the plant in Georgia. What sort of resolution can we expect on that front?
Before discussing what kind of solution there is, realistically, without a solution, it's difficult to invest in the United States and carry out the various joint projects currently planned between South Korea and the U.S. We absolutely must find a solution. Several projects are underway between South Korea and the U.S. Without resolving the visa issue, meaningful progress remains virtually impossible. The detention incident dealt a severe blow not only to the general Korean public, but especially to the workers who were actually detained. In the absence of firm assurances regarding their safety, both they and their families are understandably reluctant to enter the U.S. again while this matter remains unresolved.
Are investment projects right now halted until some resolution is acquired on the visa issue?
Although the projects have not been entirely halted or formally placed on hold, it will be very difficult for a large number of workers to enter or re-enter the U.S. until this problem is resolved.
South Korean firms are also seeing challenges, for example, in China, especially when it comes to U.S. chip restrictions for Beijing, Korean firms operating in China. How can South Korea manage the growing tech rivalry between China and the United States?
That's a problem the whole world is grappling with. It's a natural concern, especially for countries like Korea that share significant economic ties with both the United States and China. Naturally, we strive to maintain good relations with all neighboring countries. However, we understand that the overall plate we stand on has tilted slightly compared to the past.
In what way?
The terrain itself has tilted towards strengthening our relationship with the United States. I can answer it in that way.
South Korean Prime Minister Min-Seok speaking exclusively with Bloomberg Chery in Seoul. We'll have more ahead on the Asia trade. This is Bloomberg. Let's take a look at how Asia markets are setting up for the session after Wall Street's rally, which was, of course, being led by tech, took a bit of a breather. Couple of tech-related developments, including Micron giving the upbeat forecast, but that did not quite benefit the stock. We also saw Intel reportedly seeking an investment from Apple, but because of the risk-reward profile overall, investors saw fit to take some money off the table, and we'll see how that plays out in Japanese equities today, which of course yesterday was also boosted by tech, along with some of the energy-related names. Over in Australia, that really was the underperformer yesterday, and that looks to potentially continue today with futures pointing to declines of about 0.5%. And this is against the backdrop of the inflation print from Australia coming in faster, which dampens some bets of the RBA rate cuts. We'll have more ahead on the Asia trade. This is Bloomberg. This is the Asia trade. Here are some stories we're following. A shooting at an ICE detention center in Dallas has left 2 people dead, including the gunman, in what the FBI describes as an act of targeted violence. Officials say rounds bearing anti-ICE messages were found near the shooter, who died from a self-inflicted wound. Several other people were injured, but no officers were among them. Homeland Security Secretary Kristi Noem says the attack is under investigation. The Trump administration has launched investigations into imports of robotics, industrial machinery, and medical devices, setting the stage for fresh tariffs. The investigations are under Section 232 of the Trade Expansion Act, rather than the emergency powers being challenged in the courts. New tariffs could come in addition to country-based levies already in force. The U.S. is blocking retail sales of bicycles made by Taiwan's Giant Manufacturing over forced labor concerns. Customs and Border Protection says an investigation found evidence of abusive working and living conditions, debt bondage, and withholding of wages. An industry publication in the U.S. quotes a giant statement saying the company remains dedicated to protecting labor rights. Paul?
Let's take a look at how some commodities are tracking. We did see copper rallying 3% overnight, and this is at the same time we saw Freeport McMoran shares sinking as well. The company declaring force majeure after that severe accident at its Grasberg site in Indonesia back on the 8th of September. We've also seen oil steadying somewhat, slipping a little bit at the moment, but we did see it rise and hold for a while after President Trump appeared to change course on his position on the war in Ukraine. We also saw U.S. energy names breaking higher, 52-week highs. Inpex in Japan, meanwhile, hit a record. Take a look at the gold price. Meanwhile, that's slipped off record highs. Still pretty strong, though, mainly a function of the gains that we've seen to the U.S. dollar rather than any particular weakness in the precious metal. A number of analysts expect gold to continue going higher. Avril.
Yeah, you talk about how some of these energy-related names have been climbing, and underpinning that, of course, is oil prices. We are weighing out what NATO allies have been suggesting. They seem to be struggling to coordinate a response to Russian airspace violations, with partners in the defense alliance openly contradicting each other. Germany is warning against the risk of shooting down Russian aircraft, while President Trump takes a more aggressive stance. With us now is Maria Snegovaya, Senior Fellow for Russia and Eurasia at the Center for Strategic and International Studies. Really good to have you with us. First off, would you potentially unpack for us some of the rhetoric that's come out from the U.S. President at the UNGA? Is your assessment that he has ramped up the heat or is more hawkish on Russia?
I think that over the last months, not just yesterday, U.S. President Trump's rhetoric on Russia has significantly strengthened. In fact, in the past, he deliberately, seemingly tried to avoid talking, saying rough things about Russian President Putin. It is clear that over the time, his attitude towards Russia has been changing, as most prominently demonstrated yesterday during the UN talk, but also throughout the last months. We also see that the United States continues to provide weapons to Ukraine, even if through a new scheme. These are paid deliveries now, assisted with NATO. There's also intel that is being provided to Ukraine, along with sanctions that are being kept in place. One thing that is left to be seen is, of course, the intensification of current sanctions on Russia, because Russia is very successful in circumventing them. And as President Trump himself has repeatedly stated, Russia's economy is not in very good situation, and enforcement of sanctions and additional rounds of sanctions on Russia would be very desirable in the moment in order to further assist Ukraine.
What's your assessment of, at this stage, given how NATO allies to some extent seem to have disagreements in how they are going to deal with Russian incursions, does that affect the response to Moscow, and how important that there's unity on that front?
Oh, well, of course, the transatlantic unity is the key issue. And I would argue the key unknown variable here, as we are seeing intensification of Russia's conventional warfare against Ukraine on the battlefield and its hybrid warfare against Europe through these various violations, for example, of the airspace, sabotage campaigns, election interferences, and intensification of propaganda and information manipulation in Europe. All of that can be countered only with stronger resilient alliance. However, the key unknown variable is the U.S. role in this situation, this dynamic. We've been tracking very carefully President Trump's position on this issue. It remains to be seen whether the U.S. will be willing to more strongly engage on the side of the alliance. And I would argue that over the last months, we have seen that the European states, allies, have been quite successful in trying and persuading, convincing the American side to get on their side side. And perhaps that is one of the reasons why Russia has intensified hybrid warfare against Europe over the last weeks. That is probably with an intent to further intensify the divisions within Europe, within the transatlantic allies, expose NATO weaknesses and ability to react decisively in case Russian jets or drones violate the European airspace, and also make the European public shift in its position on Ukraine, essentially making the argument that why are we, wasting our precious resources on Ukraine while we also need them at home domestically, therefore undermining the provision of military aid to Ukraine.
Maria, I want to dig into that idea a little bit more that President Trump suggested, NATO countries should shoot down Russian jets that violate their airspace. I mean, you've touched on some of the questions around there. Where's the line in which the U.S. would be prepared to back that kind of action? But can you talk to us about some of the scenarios that might occur if that happened, if NATO did shoot down a Russian jet, say, over Poland, for example?
First of all, I would argue that Vladimir Putin and Russia understands strength, right? It's been shown repeatedly that trying to compromise with Russia, appease Russia, unfortunately, does not deliver. And at this point of escalation with the West, I think it's quite, everybody will agree that it's unlikely that Putin will be willing to respond to soft measures. In fact, we have seen repeatedly the failure of diplomatic engagement with Russia to deliver any serious concessions on Ukraine. So that is important. A strong posture is important vis-a-vis Russia. However, there are just objective, legitimate limits to how far Europe can go, because this is a new sort of, element of escalation in this unraveling spiral in Russia's relationship with Europe. And there are no clear rules as to how Europe should act. There's no clearly defined rules of engagement. And shooting jets and drones, as the European states often claim, would make them the initiator. And Russia at the same time will claim plausible deniability. Our drones got lost. They were really not intended for Poland. And accordingly, Europe has escalated prematurely. That's the concern, especially given that Russia is a nuclear power, and the concern is always that this current dynamic will lead us to Third World III or some sort of nuclear escalation, as many leaders, including Donald Trump, have repeatedly stated. Accordingly, the most likely step forward is to very clearly define the limits, and we have seen some of the European states actually go in that direction, to just warning Russia very explicitly as to what the consequences will be next time this happens, and then not failing to deliver on those steps. That is potentially more likely to deliver. I will flag one more thing, that right now Russia is deeply entangled in the war in Ukraine. It is pushing forward. It is still hoping to win the war of attrition, but things are not so great for Russia, and it's been essentially quite busy trying to push forward even in the Donetsk region. That means that Russia is not really at capacity at the moment to start open another front with Europe. It's important to keep in mind that it is more likely a threatening gesture rather than serious preparedness to enter a conventional escalation with Europe.
All right, Maria Snegovaya, Senior Fellow for Russia and Eurasia at CSIS. Thanks so much for joining us. We do have more ahead on the Age of Trade. This is Bloomberg. South Korean President Lee Jae-myung has reportedly met with U.S. Treasury Secretary Scott Bessent in New York. The Chosun Daily says Lee explained to Bessent how South Korea's economy differs from Japan's as the two countries work to finalize their trade agreement. And South Korean Prime Minister Min-Seok also spoke exclusively to Bloomberg about the latest on the tariff negotiations.
This negotiation wasn't initiated by us. We didn't start from a position of advantage, nor did we raise the issues. Isn't that the case for the entire world? Since the whole world is negotiating under the new conditions presented by the United States, rather than insisting on specific conditions, the correct answer would be that certain things are simply difficult to achieve. Therefore, anything that exceeds the limits of what the Republic of Korea can bear in terms of national interests, acceptability, capacity, or public understanding will be quite difficult to undertake.
are the issues that need to be resolved around the $350 billion investment fund into the U.S.?
That's generally the case, since the framework for the large amount is already set. The fact that the amount is fixed means it started with the expectation that depending on how that amount is structured, it could potentially be mutually beneficial. However, the structure itself, how the funds are raised or how the profits are distributed, these things need to be within the bounds of what's considered normal. And when explaining to our Korean citizens, it needs to be at a level where they can understand and accept it. Above all, it must be within the capacity of our Korean economy to handle.
President Lee talked about the need for a currency swap agreement in order to avoid any shocks to the Korean economy when delivering these funds. What has Washington said so far?
I haven't heard the exact details yet on how they've responded so far. However, as the president has already stated, that amount currently represents 70 to 80% of Korea's total foreign exchange reserves. Without measures like swaps or similar mechanisms, the impact on the Korean economy will be too severe. Also, as a nation that had experienced a foreign exchange crisis, public vigilance on this matter is high. I believe these factors must be taken into consideration.
When it comes to the tariff themselves, we still have to see the U.S. actually lowering car tariffs on South Korea to the agreed 15%. And even if the tariffs were lowered, the tariff advantage that South Korean car makers had over Japan, for example, 2.5% before the Trump trade deal, that's going to disappear. How painful is that for South Korean firms right now?
First, the FTA structure between us and the U.S. is changing, and that will create a burden. Naturally, if tariffs drop from 25 to 15%, that will be better, but it's still harder than before, and especially at this point. There's the difficulty of having to bear the 25% until this negotiation concludes. So, in short, there are difficulties. Hyundai Motor and others are facing particular challenges. However, as far as we understand, Hyundai Motor currently plans to navigate this situation without changing its pricing policy for now. I personally view this as a relatively wise approach. The government is reviewing various policy options to see what can be done to alleviate the burden on the automotive sector caused by the ongoing negotiations.
More problematic also for Korean companies has been the visa issue, especially with the plant in Georgia. What sort of resolution can we expect on that front?
Before discussing what kind of solution there is, realistically, without a solution, it's difficult to invest in the United States and carry out the various joint projects currently planned between South Korea and the U.S. We absolutely must find a solution. Several projects are underway between South Korea and the U.S. Without resolving the visa issue, meaningful progress remains virtually impossible. The detention incident dealt a severe blow not only to the general Korean public, but especially to the workers who were actually detained. In the absence of firm assurances regarding their safety, both they and their families are understandably reluctant to enter the U.S. again while this matter remains unresolved.
Are investment projects right now halted until some resolution is acquired on the visa issue?
Although the projects have not been entirely halted or formally placed on hold, it will be very difficult for a large number of workers to enter or re-enter the U.S. until this problem is resolved.
South Korean firms are also seeing challenges, for example, in China, especially when it comes to U.S. chip restrictions for Beijing, Korean firms operating in China. How can South Korea manage the growing tech rivalry between China and the United States?
That's a problem the whole world is grappling with. It's a natural concern, especially for countries like Korea that share significant economic ties with both the United States and China. Naturally, we strive to maintain good relations with all neighboring countries. However, we understand that the overall plate we stand on has tilted slightly compared to the past.
In what way?
The terrain itself has tilted towards strengthening our relationship with the United States. I can answer it in that way.
What does that mean for China-Korea relations then?
I think China understands this too. If Korea, standing on this larger terrain, demonstrates appropriate efforts to maintain its relationship with China, understanding the changed terrain, then even on that terrain, Korea can still strive to maintain its relationship with China.
But the U.S. has had so many demands for South Korea, including, for example, raising defense spending, 5% of GDP. As for NATO, for example.
With respect to defense spending, I do not believe it must necessarily be considered in connection with our relations with other countries. Rather, it is an area that can be expanded as part of strengthening our independent national defense.
By how much?
Recently, we mentioned 3.5%, and we did so because we judge that this is a level we are capable of sustaining.
Are we expecting any contact between North Korean leader Kim Jong-un and President Trump during the upcoming APEC summit?
Both of them are currently evaluating the relationship between the two parties positively. Since unforeseen events can always occur, I believe we should keep that possibility open. But so far, North Korea and Chairman Kim Jong-un are showing no signs of changing their stance.
President Lee created a positive foundation for South Korea-Japan ties during his last visit to Tokyo. We might see a leadership change in Japan. Could this have an impact on Korea-Japan relations as well?
We hope that won't be the case. We believe it is undesirable for relations between nations to be significantly impacted or altered by changes in leadership. While we also face various challenges, we have prioritized diplomatic continuity and are working to further improve relations with Japan. Regardless of who becomes Japan's new prime minister, we expect and hope that they will consider various factors to ensure that the current, newly formed friendly atmosphere is not adversely affected.
South Korean Prime Minister Kim Min-Seok speaking exclusively with Bloomberg's Chery in Seoul. And checking some of the stocks to watch when trade opens in Australia, Korea and Japan shortly. Watch how chip equipment suppliers respond as the tech-driven rally in the U.S. begins to wane. Tokyo Electron is in particular focus after the Nikkei reported it may face delays in achieving its midterm plan. U.S.-traded ADRs are suggesting a drop at the open. Tokyo Marine also one to watch after the Nikkei reported it has announced a partnership with OpenAI and tracked Suzuki today with its stock price diverging from its Japanese peers due to its unique exposure to India. Now, Nissan is also in focus on news that it's halting production of the Ariya EV line for delivery to the U.S. in order to focus on the Leaf model. Kyodo reports the decision is due to U.S. tariffs and weak EV demand, Poole.
Also, watch the energy sector at the open. Following a late U.S. rally for the Energy Select Sector Fund, we've got crude oil rising as traders weigh NATO uncertainty over Russia's airspace incursions. We have more ahead on the Asia Trade. This is Bloomberg.
This is the Asia Trade. Some other stories we are following. The U.S. is preparing a $20 billion swap line for Argentina and may buy the country's bonds, providing support for President Javier Milei as he works to regain investor and voter confidence. U.S. Treasury Secretary Scott Bessent told Fox News the financing is intended to assist Milei ahead of next month's midterm elections. Democratic Senator Elizabeth Warren calls it a bailout for a Trump political ally. China has pledged to cut greenhouse gas emissions up to 10% by 2035. President Xi Jinping told the UN Climate Summit his country will also increase renewables to more than 30% of its energy use. Environmentalists call the targets cautious, but Greenpeace and other analysts say China's rapid build-out of wind and solar could lead to deeper cuts than promised.
Yeah, well, let's get to today's agenda and, shout out to our colleagues and everyone else in Hong Kong who spent the day pretty much in hiding yesterday. Avril, Typhoon Ragasa has passed. It was a pretty bad storm, winds up to 175 kilometres per hour, expecting insurance claims of about $50 to $100 million. So it's a substantial sum, but not as expensive as what we saw back in 2018. Typhoon Manghat back then causing damage of almost $500 million. The storm now moving on.
Yeah, it's since moved on or is moving on to Vietnam. And don't forget, Paul, this is after already hitting Hong Kong and leaving this trail of destruction in both the Taiwan and the Philippines, where we've seen casualties of about 15 people killed in Taiwan and I think 6 in the Philippines as well. So as we continue keeping tabs, and I bet insurers also will be assessing the damage in terms of claims. This is really quite startling, some of the pictures that have come out from the storm this week. Now, let's also take a look at how the Japanese currency is faring. We've since gotten some of the minutes from the BOJ's July meeting. So this is not the one where we saw 2 dissenters that some market watchers read as a bit of a hawkish move. They are saying that they are agreeing to hike rates if the economic outlook is realized. Again, this is the minutes for the July meeting. We're seeing dollar yen, though, breaching their 200-day moving average level. This is mostly because of the moves in the greenback. Markets open in Sydney, Seoul, and Tokyo next. This is Bloomberg. This is the Asia trade. We're counting down to Asia's major market opens. And Paul, tech is really the undercurrent here on Wall Street. We saw the rally taking a breather, but it's really interesting how the likes of Chinese tech giant Alibaba, as soon as some of these names up or increase their AI spending, they are getting rewarded by the market. So that's something we're going to be tracking for the session today, Paul.
Yeah, absolutely. Had a huge run-up in Alibaba yesterday on its announcement there'll be more AI spending. We've also got Tencent starting to close in on a record as well. That typhoon that we saw in Hong Kong certainly didn't dampen market spirits at all, and it'll be interesting to see how we set up for trade today, Avril.
Yeah, things looking pretty upbeat. Let's see how Japan is faring. We did see mild gains just a day ago, and this was led by tech as well as some of the energy-related names, including impacts tracking what we see in oil prices amid hawkish rhetoric from Trump towards Russia. But for the moment, we are quite flat on the region's benchmark, or on the Japanese benchmark, I should say, while the broad-based gauge is doing a bit better. Worth highlighting, we have a 40-year sale of Japanese JGBs that are due for today, but that is expected to pass safely as the finance ministry cuts issuance. We are also seeing the dollar yen moves nudging towards the 149 handle, but that is since being reversed a little at the moment. And of course, take this in context with what we're seeing in the moves on the greenback overnight, that rebound as traders paired their expectations for Fed rate cuts. Let's take a look at how that might be playing out in dollar Korea won, that of course has also been coming under pressure, the local currency. It's hovering at the 1401 level for the moment. Again, relatively weak despite a bit of that rebound you're seeing on the Korean currency for the moment. There is also a drag we're seeing on South Korean stocks, but of course geopolitics never far from our minds when it comes to some of these market moves. We did get South Korean media talking about the Korean president meeting with the Treasury Secretary Scott Bessent in New York. And of course, the Prime Minister of South Korea in an exclusive interview with Bloomberg TV talking about how these investment pledges, you can't really see them coming through without the visa issues being resolved, Paul.
Yeah, let's take a look at how trade and US debt is tracking. Meanwhile, in the early going, you see the yield on the 10-year, a little change there, 4.14. That's pretty much where it was at the close of the US session as well. We saw new home sales in the US surging by the fastest pace since 2022. Treasury Secretary Scott Bessent sharing some more views on Fed policy as well, saying rates are too restrictive, need to come down by another 100 to 150 basis points, before the end of the year. Anyway, let's take a look at how we're tracking in Australia also. So we got the ASX a little bit softer by 1/5%, but what you're not seeing in that number is the rally that we've got going on in materials and energy, both those two sectors in positive territory, despite the drag from the rest of the index, because we have seen the oil price rising as well. This is after President Trump appearing yesterday to change course on Ukraine. We saw US energy names breaking to fresh 52-week highs, Impex in Japan hitting a record, and Australian energy stocks going along for the ride this morning as well. Brent crude finding a floor there at 69.05 at the moment. All right, let's get to our next guest. Isaac Poole is CIO at Ascalon Capital. Isaac, I just want to start with your view on what we saw in the US session earlier today. Is this rally starting to look a little bit tired now? What are we going to see next? Some consolidation, a correction, or the pause that refreshes and another leg higher?
I think you are starting to see just a little bit of wariness creep into investors. This has been an astonishing rally. It's pushed to record price highs, but more importantly, it's pushing valuations to levels that are just materially above long-run averages. And I think that's not a controversial statement. Almost every investor we speak to is highlighting that these valuations feel toppy, and yet they don't want to miss out on the potential upside. I think where we go from here is going to be contingent on a couple of things. One, just how quickly and how far the Fed can cut rates, and two, just how quickly and how high the unemployment rate moves up. And the combination of those two will determine whether we see a correction or a sideways movement, or, as you say, a pause that refreshes.
In this environment, what do you prefer, equities, or do you look to quality bonds instead?
This is a hard time to go overweight equities, I think. If you start adding exposures here at these levels, the real risk is that you're buying right at the top and locking yourself in for poor forward-looking returns. And historically, valuations at this level have delivered just that. From a diversified portfolio perspective, it really is an opportunity to look for very high-quality fixed income. That was, from our perspective, back when US Treasury yields, and the 10-year in particular, was sitting at 5%, a bit of a no-brainer. It's become less clear now that you want to be materially overweight that sort of fixed income. But there are opportunities in the shorter duration part of the Treasury yield curve. There's opportunities in short spread duration, investment grade credit, which we think will offer okay returns, decent downside protection or resilience in the case of IG credit, without really giving up a massive amount of comparative return compared with equities.
We are seeing these elevated yields prompting a sort of rebound in the dollar, along with some of these paired bets of the Fed's rate cuts. Among the G10 space, what are you perhaps more constructive on, and how are you viewing particularly the Australian dollar?
Yeah, I think that there's a big and growing consensus that the Aussie dollar is set to rally back up towards 70 cents or so, and we've seen that become a consensus based on the Fed likely cutting rates more aggressively than the RBA, who are going to cut, but have been a little bit more cautious in their approach. I think it's important to remember that the Aussie dollar has always been and is likely to continue to be a risk currency. we're moving towards a world of slowing economic growth. The Fed is cutting rates, but they're cutting rates for a reason. And in that environment, I think there's scope that the Aussie dollar may have already peaked, and that we see something closer to 60 cents than we do 70 cents by the end of this year. More broadly, when you step away, I think the USD weakness story is overdone against a lot of the other G10 currencies. And if we see the Fed cutting rates, yes, rate differentials will matter. But if the economy is slowing, then that safe haven bid will come back to the USD, and I suspect we'll see at least stabilisation, if not some strength, after the 10% or so fall we've seen in the dollar this year.
You talk about risk currencies. What about the Chinese yuan that has been climbing steadily in the past couple of months?
It has been, and I think it's reflective, partly at least, of capital flowing back into China after the equity market was considered broadly uninvestable by a lot of global, particularly real money investors. That's no longer the case. We're hearing quite often now that those real money, large pension funds, sovereign funds, are looking to gain exposure back into China equities, particularly in the tech sector, particularly given that the trade uncertainties are driving R&D and capex spending amongst that tech sector. I think that's sucking capital back into a market that really was an outflow for several years, and hence there's a bit of upward pressure or strengthening pressure on the Chinese currency now. And I think that's also been very supportive of at least parts of the Chinese equity market.
Isaac, when you look at some of the spending that's going on in the tech sector, particularly around AI, I mean, the market loves it every time we get a big announcement like we had with Alibaba yesterday. But do you have any concerns about the amount of spending that's going on here and when some of these investors are going to see a return on investment?
Lots of concerns. I think it's really sensible when you see prices move up this far and this quickly to put your skeptical hat on as an investor and question what's going on under the hood. And what we've seen over the last couple of months or so has been circular spending, so investments from one company into another who is then going to buy infrastructure or goods off that original company. We're seeing some questionable accounting practices potentially with capex being depreciated well beyond the likely useful life of the capex, and that has the effect of pushing up margins and obviously boosting earnings growth. But I think that the AI story is real. It's going to improve productivity. We are going to see benefits from this. It's just not clear that we're going to see them in a time frame that is going to justify the PE ratios that this sector is sitting at, and that I think is a risk, because when you see these prices push up to this level, it means that there's further to fall if we see a correction, and I think that's something that's not been discounted by investors at the moment.
Some reason to be cautious. Isaac, really good to chat with you. Thanks so much. Isaac Poole is CIO at Ascalon Capital. Let's take a look at some of the movers today. In Japan, of course, we saw around those record highs impacts. This is, of course, an oil exploration related stock, energy name there, and it has been extending the gains from a day ago. Also doing well in trade today, some of the other energy related counters in Australia, including Woodside, even though the climb that we've been seeing in commodity prices, particularly oil, is taking a bit of a breather today, Paul.
Yeah, we're seeing some moves higher for some of the big copper miners as well. Rio Tinto, BHP, both among the top 10 performers on the ASX at the moment. We did, of course, have the news that Freeport McMoran has declared force majeure now at its Grasberg mine in Indonesia. This is after the big mud flow that left 2 employees dead, 5 more missing. So that declaration could mean Freeport can't meet its supply contracts from the mine. So copper prices getting a boost, and some of Freeport's competitors getting a boost there also. We have more ahead on the Asia trade. This is Bloomberg. Let's take a look at how Korean assets are tracking at the moment. We've got the won showing some gains against the greenback, but elsewhere stocks starting to give up a little bit of ground. We have heard from the South Korean president today, been speaking to Scott Bessent, the US Treasury Secretary, just explaining that South Korea and Japan are very different economies in terms of scale, foreign exchange, infrastructure. He hopes that gets taken into account during discussions on trade. Also key to those conversations is a dedicated visa category for South Korea. Most countries that have FTAs with the US have this. South Korea does not. And of course, we saw that earlier this month with hundreds of South Koreans deported after a raid at the Hyundai battery plant, which is under construction in Georgia. So South Korea expressing a need to get that sorted out. Well, South Korean President Lee Jae-myung, as I mentioned, has reportedly met with the US Treasury Secretary Scott Bessent in New York. Chosen Daily there saying Lee explained how South Korea's economy is different. The two countries working towards finalizing that trade agreement. In the meantime, we spoke to South Korean Prime Minister Min-Seok, who spoke exclusively to Bloomberg about the latest on the tariff negotiations.
This negotiation wasn't initiated by us. We didn't start from a position of advantage, nor did we raise the issues. Isn't that the case for the entire world? Since the whole world is negotiating under the new conditions presented by the United States, rather than insisting on specific conditions, the correct answer would be that certain things are simply difficult to achieve. Therefore, anything that exceeds the limits of what the Republic of Korea can bear in terms of national interests, acceptability, capacity, or public understanding will be quite difficult to undertake.
Are the issues that need to be resolved around the $350 billion investment fund into the U.S.?
That's generally the case, since the framework for the large amount is already set. The fact that the amount is fixed means it started with the expectation that depending on how that amount is structured, it could potentially be mutually beneficial. However, the structure itself, how the funds are raised or how the profits are distributed, these things need to be within the bounds of what's considered normal. And when explaining to our Korean citizens, it needs to be at a level where they can understand and accept it. Above all, it must be within the capacity of our Korean economy to handle.
President Lee talked about the need for a currency swap agreement in order to avoid any shocks to the Korean economy when delivering these funds. What has Washington said so far?
I haven't heard the exact details yet on how they've responded so far. However, as the president has already stated, that amount currently represents 70 to 80% of Korea's total foreign exchange reserves. Without measures like swaps or similar mechanisms, the impact on the Korean economy will be too severe. Also, as a nation that had experienced a foreign exchange crisis, public vigilance on this matter is high. I believe these factors must be taken into consideration.
When it comes to the tariff themselves, we still have to see the U.S. actually lowering car tariffs on South Korea to the agreed 15%. And even if the tariffs were lowered, the tariff advantage that South Korean car makers had over Japan, for example, 2.5% before the Trump trade deal, that's going to disappear. How painful is that for South Korean firms right now?
First, the FTA structure between us and the U.S. is changing, and that will create a burden. Naturally, if tariffs drop from 25 to 15%, that will be better, but it's still harder than before, and especially at this point. There's the difficulty of having to bear the 25% until this negotiation concludes. So, in short, there are difficulties. Hyundai Motor and others are facing particular challenges. However, as far as we understand, Hyundai Motor currently plans to navigate this situation without changing its pricing policy for now. I personally view this as a relatively wise approach. The government is reviewing various policy options to see what can be done to alleviate the burden on the automotive sector caused by the ongoing negotiations.
More problematic also for Korean companies has been the visa issue, especially with the plant in Georgia. What sort of resolution can we expect on that front?
Before discussing what kind of solution there is, realistically, without a solution, it's difficult to invest in the United States and carry out the various joint projects currently planned between South Korea and the U.S. We absolutely must find a solution. Several projects are underway between South Korea and the U.S. Without resolving the visa issue, meaningful progress remains virtually impossible. The detention incident dealt a severe blow not only to the general Korean public, but especially to the workers who were actually detained. In the absence of firm assurances regarding their safety, both they and their families are understandably reluctant to enter the U.S. again while this matter remains unresolved.
Are investment projects right now halted until some resolution is acquired on the visa issue?
Although the projects have not been entirely halted or formally placed on hold, it will be very difficult for a large number of workers to enter or re-enter the U.S. until this problem is resolved.
South Korean firms are also seeing challenges, for example, in China, especially when it comes to U.S. chip restrictions for Beijing. Korean firms operating in China. How can South Korea manage the growing tech rivalry between China and the United States?
That's a problem the whole world is grappling with. It's a natural concern, especially for countries like Korea that share significant economic ties with both the United States and China. Naturally, we strive to maintain good relations with all neighboring countries. However, we understand that the overall plate we stand on has tilted slightly compared to the past.
In what way?
The terrain itself has tilted towards strengthening our relationship with the United States. I can answer it in that way.
What does that mean for China-Korea relations then?
I think China understands this too. If Korea, standing on this larger terrain, demonstrates appropriate efforts to maintain its relationship with China, understanding the changed terrain, then even on that terrain, Korea can still strive to maintain its relationship with China.
But the U.S. has had so many demands for South Korea, including, for example, raising defense spending, 5% of GDP. As for NATO, for example.
With respect to defense spending, I do not believe it must necessarily be considered in connection with our relations with other countries. Rather, it is an area that can be expanded as part of strengthening our independent national defense.
By how much?
Recently, we mentioned 3.5%, and we did so because we judge that this is a level we are capable of sustaining.
Are we expecting any contact between North Korean leader Kim Jong-un and President Trump during the upcoming APEC summit?
Both of them are currently evaluating the relationship between the two parties positively. Since unforeseen events can always occur, I believe we should keep that possibility open. But so far, North Korea and Chairman Kim Jong-un are showing no signs of changing their stance.
President Lee created a positive foundation for South Korea-Japan ties during his last visit to Tokyo. We might see a leadership change in Japan. Could this have an impact on Korea-Japan relations as well?
We hope that won't be the case. We believe it is undesirable for relations between nations to be significantly impacted or altered by changes in leadership. While we also face various challenges, we have prioritized diplomatic continuity and are working to further improve relations with Japan. Regardless of who becomes Japan's new prime minister, we expect and hope that they will consider various factors to ensure that the current, newly formed friendly atmosphere is not adversely affected.
South Korean Prime Minister Min-Seok speaking exclusively with Bloomberg Chery in Seoul. We'll have more heads on the Asia trade. This is Bloomberg. Yeah, the top global headlines are following. The U.S. is blocking retail sales of bicycles made by Taiwan's Giant Manufacturing over forced labor concerns. Customs and Border Protection says an investigation found evidence of abusive working and living conditions, debt bondage, and withholding of wages. An industry publication in the U.S. quotes a Giant statement saying the company remains dedicated to protecting labor rights. The Trump administration has launched investigations into imports of robotics, industrial machinery, and medical devices, setting the stage for fresh tariffs. The investigations are under Section 232 of the Trade Expansion Act, rather than the emergency powers being challenged in the courts. New tariffs could come in addition to country-based levies already in force. The U.S. is preparing a $20 billion swap line for Argentina and may buy the country's bonds, providing support for President Javier Milei as he works to regain investor and voter confidence. U.S. Treasury Secretary Scott Bessent told Fox News that the financing is intended to assist Milei ahead of next month's midterm elections. Democratic Senator Elizabeth Warren calls it a bailout for a Trump political ally, Paul.
Let's take a look at how European futures are tracking at the open. A little bit of softness there. Let's call it flat. We're only off by a couple of points there. The euro showing some strength against the greenback, 117 at the moment. We did get the news that the US is going to lower tariffs on auto imports from the European Union to 15%. That'll be retroactive from August the 1st, so perhaps a sign there that trade relationship is starting to normalise. The European Commission also announced on Wednesday it will propose new tariffs on Russian oil. This is amid growing calls from President Trump for the bloc to cut all imports of Russian energy products. Avril.
Yeah, let's take a look at how the Asia benchmarks are faring. You have that downdraft from Wall Street playing out in the Asia session. Remember, tech took a bit of a breather overnight. The Nikkei, the Kospi, sitting slightly lower for the moment as Wall Street fatigue sort of sets in. More ahead on the Asia trade. This is Bloomberg. Tropical Storm Ragasa is moving toward northern Vietnam after battering the Philippines, Taiwan, and Hong Kong over the past 2 days. Our chief North Asia correspondent, Stephen Angle, joins us live from the Hong Kong district of Cheong Kwan O, where huge waves caused significant damage. Steve, what have you been seeing there?
Yeah. Well, I think the key takeaway is this could have been much worse than it was yesterday. Of course, this was the largest storm on record this year, not only just in the North Pacific, but globally. So Hong Kong people have fresh memories of 7 years ago with Typhoon Mangkhut, which was tracking along the similar path as Ragasa did yesterday, packing huge winds upwards of 200 kilometers per hour. So they were bracing for this. As you can see, the storm surge is what caused most of the damage in places like Cheong Kwan O here. This is the restaurant Makan Makan. As you can see, the storm surge really blew out the windows and blew out the restaurant, essentially. All along here are a number of restaurants that have been severely damaged. You can see also this is due south here. So the storm, which tracked 100 kilometers due south, really created a lot of storm surge that came over the road and into these restaurants here. Now, keep in mind, there have been just 19 typhoons that have hit Category 10 or higher since 1946. 19 of them. Category 10 is the highest ranking here in Hong Kong, and we've already had 2 of them this year. So that's why it's quite concerning, obviously, about the rise in the number of typhoon activity, because we've had 11 hoistings of typhoon signals, whether it's typhoon signal 1, 3, 8, 9, or 10. There have been 11 of them, which is a record year. So Hong Kong was definitely bracing for significant damage, but because the outer eye was probably not as strong as the tight inner eye. It caused less damage than Mangkut, which was more spread out and caused significantly more damage. I think the insurance companies are tallying it up right now, where Mangkut was upwards of $500 million in damage. The initial estimates right now for Ragasa are between 50 to 100, maybe 150 million. Still too early, but we are ourselves assessing the damage in the restaurants here. Fortunately, no reported deaths. There was one woman who is in hospital in critical condition after falling into the sea. There were a number of deaths in Taiwan before it hit here. There were millions of displaced people in nearby Guangdong province. The Philippines had a number of deaths, but again, single digits. Hong Kong, no reported deaths. So I think we pretty much took the brunt of the storm and fared fairly well. So that's a blessing, obviously, in what has been a record typhoon season here in Hong Kong.
Stephen, it's just crazy to think that with all the damage we're seeing and you're showing us behind you that it actually could have been worse. But as you say, thankfully, not as bad as what we were bracing for. Steve Engel, thank you for your reporting. Bloomberg's chief North Asia correspondent for us. Now, let's take a look at how markets are faring in Japan as well. In terms of bonds, we are expecting that 40-year auction. Some think it could pass safely, that the yield curve is decently steep enough to draw in some demand. But aside from that, we also heard from the Finance Ministry proposal about reducing issuance for October and December. And then don't forget some of these comments that have come in from LDP front runners on the path of the BOJ. Let's bring in Bloomberg's Japan Economy and Government Editor Poole Jackson. Great to see you, Poole.
Likewise.
So we are watching out for this 40-year sale. What are we expecting here?
I think it's going to be absorbed pretty steadily in the market. I don't think there's going to be too many concerns about this particular auction. What we're seeing is policymakers are making moves to try and kind of manage some of this uptick in yields. We've seen the Ministry of Finance reaching out to the primary dealers. We saw this move yesterday to kind of limit the issuance in the super long end of the market. And I think these moves will help to kind of ease a little anxiety, even though the actual moves themselves aren't that large. This just relates to the enhanced liquidity issuance. So it's a kind of smaller segment overall of the issuance. But in terms of the optics, it looks good. It looks like policymakers are keeping an eye on these yields and are trying to limit the uptick. And if we're looking at the 20-year, we're around about the 2.6 mark at the moment. That's compared with about 1.6 a year ago. So you can see there has been a lot of movement that has fed into this anxiety. In terms of the LDP election, you mentioned the comments of frontrunners like Sanae Takaichi. She does seem to be softening her position in terms of how aggressive she's going to be acting in terms of the fiscal stimulus. And she's using language like more responsible active fiscal policy. And I think this fits into the overall pattern this time with the LDP election, that the frontrunners are trying to kind of tone down their remarks to better ensure that they can win, and we don't have a central kind of candidate coming through the middle like happened last year with Ishiba.
All right, Bloomberg's Japan Economy and Government Editor Poole Jackson there. Well, tech is a major focus today. Lots of headlines in the chips and AI space. Let's start with Intel. We saw shares soaring after Bloomberg reported that it's approached Apple about securing an investment. Our Asia tech correspondent Annabelle Drewlers joins us now from Hong Kong. Belle, Apple's got its own in-house processes. What's the appeal for a tie-up with Intel?
Yeah, that's what's really unknown at this stage. As you said, they switched to in-house processors about 5 years ago. They were a very long-time Qualcomm customer before that, or Intel customer before that. Big question, yes, what would be in it for Apple? But certainly just the report and our reporting on this has been enough to spur even further interest in the Intel stock, because we saw it closing up around 6% higher. Apple a little bit under pressure, but that was also the general sell-off we saw in tech stocks across the board. As you said, we don't really know the shape of the deal. we just know that these discussions are preliminary, but it does follow that trend we've seen of Intel, for instance, seeking investment from NVIDIA. That also would have seemed unthinkable just a few years ago. SoftBank has tipped money in as well. And we do know that, politically speaking, these are the types of investments that the Trump administration wants to see in, of course, what has been the long-time largest chip maker in the US.
What about for Baba, Avril? I mean, what are we expecting there, given how it is upping its AI budget?
Yeah, well, it's been a stellar run for Alibaba. It's been the best performing stock in the China tech space over the past few weeks. But overall, I mean, it's been a really big run up going over the past year or so. The story very much is around AI. Of course, it faces intense competition in e-commerce, quick commerce as well. Early this year, the story was that the company was tipping $50 billion into its AI efforts. But just yesterday, the CEO, Eddie Wu, said that they'd actually need to go even further than that, because he thinks that worldwide spending on AI is going to top $4 trillion within the next 5 years. And so they say they need to even increase further to compete on the global stage as well. So that has been enough to spur further optimism in the stock. And a lot of investors like it, not just from a valuation perspective, but also one of the standouts really in the China AI space.
Yeah, Baba stock at the highest since October 2021. We will watch the open today. Asia Tech correspondent Annabelle Jolas for us in Hong Kong. We'll have more hit on the Asia trade. This is Bloomberg. Let's take a look at how commodities are faring, keeping an eye on copper after Freeport McMoran declared force majeure in its Indonesian mine. This is, of course, the second largest in the world for copper mines. And that spike you're seeing in copper prices is being reversed a little, but it does bring to mind how fragile and perhaps tight these markets are to disruptions. Take a look at how oil prices are also faring, pulling back a little from the gains of the past couple of days, and that is despite this hawkish rhetoric that we've heard from Donald Trump at the UNGA regarding Russia. Gold continues to catch a bid. We are hovering just below the 37.50 handle at the moment. Lots to unpack when it comes to commodities. Let's bring in Vivek Dhar, Head of Commodity and Sustainability Research at CBA. Vivek, really good to have you with us. Let's start with oil prices first. We are seeing some of these geopolitics developments coming back to the fore. What do you think is the risk of that disruption from the Russian side? What is an appropriate geopolitical risk premium here?
Look, in terms of the oil market, certainly in our view, when we look at Brent futures, we think something in the $65 to $70 barrel range, and it is on the upper end of that, is really supported if we look at the context of Russian fuel exports have actually taken a hit. I think this market has been, in the throes of geopolitical risk throughout this year. We're talking Israel-Iran war. We're talking, Russian supply threats. We're talking escalation in Ukraine-Russian tensions. But it is only when we see actual supply disruptions that we see markets respond. And for the first time, we're seeing how the drone attacks from Ukraine on Russian refineries are actually having an impact on physical supply. And so long as that's the case, we think that actually is not just a geopolitical premium, that's actually a physical premium that's coming in to reflect the fact that we have less diesel than people thought just 2 to 3 months ago.
How do you square that away with what markets have been contending with for much of the past year in the global glut?
Look, in terms of the forecast, they really come about in the fourth quarter of this year and the first quarter of next year. And they're sizable. We're talking surplus builds of about 3% of global demand in the next quarter and about 4% for first quarter next year. In terms of whether that's realized or not, I'd say it's dependent on two things happening. One is we have to see evidence of global stockpiles rising and above the 5-year average. And so far, we haven't seen that. In fact, if we look at the most recent data, it's actually gone the other way. The second thing we need to see to really confirm that outcome is we need to see diesel refining margins come back down. Right now, that's rising, and that's something that we think is going to be supportive of the oil complex. And we need to see more of that OPEC plus supply come in to reduce that refining margin, and therefore we should see that oil price creep lower. So we still do think that we'll get closer to $60 a barrel over the next kind of 3 to 6 months, but clearly there's upside risk to our forecast. But we need to see those two very much current indicators of the oil market really adjust in the direction of oversupply is being realized. And I think that's when the oil price will respond.
Vivek, I just want to return to that geopolitics question, if we can, and try and get a forecast from you about what might happen to oil prices if President Trump got his wish that some European nations, India, China, stopped or dramatically curbed Russian oil imports. What would be the impact on the market?
Look, clearly the impact will be that we'll see some stranded either oil supply or we'll see some stranded refined product supply. And that is clearly going to be positive for oil prices. And, seeing a price over $70 a barrel for Brent is clearly a possibility in my mind. But in terms of that being realized, I can't stress just how resilient Russian exports have been in the wake of all these sanctions from the West, particularly even U.S. sanctions. And we saw the Biden administration put that in January, and everyone thought the shipping kind of focus of that would really hurt Russian exports. And Russia just wore it, and they were just fine in terms of their exports and what we saw in the underlying data. So it really needs to come through in actual supply cuts, actual exports falling, and I think that's what we're looking at. This attack on Russian refineries is the first sizable impact on physical supply. And I'm saying that's probably worth watching in a lot more detail, because that's where that geopolitical premium becomes a physical premium. And that for me is a real catalyst for $70 plus for Brent. That's what we have to watch, as opposed to whatever US is going to announce. I feel trade markets will adapt because everyone chases that lowest cost oil barrel.
Mm-hmm. And how do you see the demand side of things evolving more broadly as well as the Fed and other central banks embark further along this easing cycle?
Yeah, look, oil demand has been de-linked a bit from GDP growth. And part of that is obviously what's happening with the EV transition and what we're seeing, particularly on the gasoline side, as we see that EV uptake increase globally. And that's really kept a lid on global oil demand. So when we look at growth this year, next year, it is going to be sub 1%. And the risk is that we're going to be in this territory, at least for the next kind of 4 to 5 years. The question on supply for me is really what will really determine where prices end up. OPEC Plus, in my view, controls just the price narrative because they effectively control how much supply they put in. And because I think last year they were targeting prices of about $70 a barrel, and that's shifted lower to 60 to 65 to really challenge US shale and non-OPEC Plus supply growth, I think that is a very comfortable position that OPEC Plus has. And that's where I think Brent oil prices will drift to, even in the medium term, given that OPEC Plus strategy.
As we watch the Fed moves, the dollar moves, what has really moved higher amid all this is gold. All bets seem to be that it can climb further. What are your expectations?
Look, our forecasts for gold are quite high. Like, we now think that gold will get to about $4,000 an ounce by the second quarter of next year. And really what's driving that, there's one cyclical and two structural. And if we look at the cyclical, we can see that relationship really unfold over the last 12 months. It's been the weakness in the US dollar. And our forecast for the US dollar to weaken another 3% as the Fed delivers their cuts, for us, that's really what's going to drive, some of this gold price increase. But the real unknowns and the parts that are really giving gold like a lot of leeway in terms of moving higher is, for me, what's happened on safe haven demand. We have seen a reordering of safe haven assets ever since the tariffs were announced in April, and that has seen gold outperform your traditional safe havens like US dollar, US treasuries. And that means any safe haven demand event now will favor gold relative to what it did prior to 2025. And because of that new structural change, we can see this gold price really pivot higher. And that's something that I think everyone is finding very difficult to forecast in terms of when exactly will that take place. But clearly, if we see ongoing disruptions to Fed independence, we see that as a bullish factor and one of the key reasons why we're seeing gold prices rise. Of course, the other one, which has been the case since mid-2022, has been central bank demand. And this has really been on the basis that what we saw between Russia and the US on the back of the Ukraine war was the US penalized Russian reserves. And as a result, we've seen central bank demand, particularly from emerging economies, really look to gold to diversify. And, we're talking 20% of global gold demand is now driven by central banks, as opposed to 10% before the Ukraine war. So it's a sizable chunk of gold demand momentum.
You talk about central bank demand. Sources also telling Bloomberg that Chinese authorities are encouraging other countries to hold their reserves in Shanghai. What do you make of a move like this in terms of, does this ramp up China's global clout, and does it have broader implications for the global financial system in your mind?
Look, it's going to be very hard. We talk about de-dollarization and kind of the aftermath that this very much touches upon. And it's very, very challenging to move away from a US-centric system. And in our view, on the margins you can have change, but a structural change away from the US dollar for us looks very unlikely, from all the data and everything that we're seeing. But on the margins, yes, whether you have gold or whether you have China playing a role, I think they all have credibility. The question is, it'll be in the margins as opposed to structural, right? And China certainly in this geopolitical environment really does have a lot to gain. Like, we are seeing a lot of countries now consider their relationship with China and be like, look, what should we develop with China, given that we may not have the Western alliance that we once thought. I think that the whole geopolitical landscape has changed. So China certainly gets a tailwind from that. But talking about China replacing or renminbi changing some of what's the US dollar, I think it's a far cry from that rhetoric.
All right, Vivek Dhar, Head of Commodity and Sustainability Research at CBA. Thanks so much for joining us. We have more ahead on the Asia trade. This is Bloomberg. We're just over half an hour to the open in Hong Kong and mainland China. The Golden Dragon Index pointing to China potentially ignoring the retreat on Wall Street. And another thing to watch is the trading debut of Chery Auto in Hong Kong. Shares have jumped as much as 10% in grey market trading. Let's get over to Hong Kong and our Asia equities reporter Charlotte Yang. Charlotte, what can we expect to see when Chery makes its debut?
Yeah, so this trading debut is a big one to watch in how it will test, how much appetite investors have for China's auto export growth story. So Chery Auto, the Wuhu-based company, it has been China's top auto exporter for the past 20 years. And in 2024, over 40% of its total sales went overseas. Its top target markets include Russia, South Africa, South America, and its cheap lineup of fuel-powered vehicles has made the brand particularly popular over there. So great trade in grey market trading. Looks like investors' appetite are quite high. But there's also a twist to Chery's story, which is that in its domestic market, it has actually been facing some challenges, given that consumers now are increasingly turning to brands like BYD for their new energy vehicles. So the IPO, the money raised, that will also be supporting Chery's R&D development as well as its overseas growth ambition.
We are also watching how Alibaba fares today. Are we headed for a cooling off day? And what might this mean for the broader Hong Kong markets?
Yeah, so the moves to Alibaba, which is now China's AI darling, is top on all traders' watch lists, particularly after the eye-watering rally we saw in Hong Kong, also overnight in the U.S. So some of the technical indicators is showing that this rally may be looking a bit too hot. So Alibaba is already being overbought, and based on 14-day RSI index, that's the most overbought level in over a year. And also we have the the long Golden Week holiday coming up, so some investors may be looking to trimming some of their positions ahead of the holiday. So, and also given how much the broader market has rallied on the index level and also on some single stock level, we could be seeing a period of consolidation for today and also rest of this week.
Charlotte, thanks so much for setting us up for the day ahead. Asia Equities reporter Charlotte Yang for us. Now let's take a look at how copper shares are faring as well. We're of course tracking it following the spike in copper prices, following that Freeport McMoran mining incident in Indonesia, which raised concerns about supply disruptions. We're seeing some of the miners really doing well in the session today. Copper stocks also in focus when markets open in Hong Kong and mainland China on our radar. A couple include Jiangxi Copper, Zijin Mining, MMG as well, Paul.
Okay, we're just 35 minutes to the open or so. Let's take a look at how we're shaping up for the start of trade in China and Hong Kong as well. We've got FTSE China futures a little bit softer today, and I don't know, perhaps not surprising since that big AI-inspired Alibaba run-up that we saw on Wednesday. The S&P futures, meanwhile, just ticking higher by about 1/10%. That is it from the Asia trade. Markets coverage does continue as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen. The China show next. This is Bloomberg.